Hi, this is a review of JPMorgan's Beta Builders US Equity ETF, symbol BBUS. This is a brand new ETF. It came out in mid-March, I think March 12th of 2019, so there isn't much historical information on it. We have less than 2 months of any information on it, but it's a very good fund, if only for its expense ratio, but it has some other information. Let's get under the hood and see what makes it tick and why I like it. But before I get too far, let me just remind you this is not investment advice. Also, these images you see, these are from JP Morgan's website and the fact sheet for BBUS. This is not my information, and if there are any mistakes in here, sorry, but that's JP Morgan's information. Okay, so let's get to a brief summary of what exactly BBUS is. So it's a sort of a total market fund. It's not an entire total U.S. market, but it is a most of the U.S. market fund. That's the idea here. So JP Morgan has gone to Morningstar for a free float index that captures what they say is 85% of the U.S. market. It accomplishes this by basically going for the largest companies. It's come up with an index that currently includes 622 companies, so it's a little broader than the S&P 500, but most total market funds, traditional total market funds, have thousands of companies. So what's missing here is no real small cap exposure and minimized mid-cap exposure, and it's those companies with small floats, not much liquidity, not much size, obviously, and probably greater volatility. But what really makes this fund interesting is the cost, that 0.02% fee. It is the lowest fee ETF out there of any sort. There is no lower equity fund, specialty, total market, bond fund, any kind of thing. So it is possible just on that basis that it'll probably outperform the majority of other ETFs, but there are other reasons to consider BBUS, including that this fund seems to have a reasonably logical, plain vanilla passive approach that could be a good first core fund or possibly supplemental core fund for individuals looking for very low fees and broad exposure to large U.S. companies. Okay, so let's take a look at the sectors here. There isn't much difference between BBUS and the S&P 500. You're basically looking at between 0.5% to 1% difference in the sector weightings between this index and the S&P 500. That's because it's mostly the S&P 500. The additional 120 or so companies don't change the fundamental weighting of these sectors. It adds a little bit of financial and technology, and of course these things drift, so it could change depending on the performance of any one company that just happens to not be in the S&P 500. But for all intents and purposes, it is an S&P 500 clone. And here, looking at the top holdings, you can see it's got all your favorites, the big blue chips that you'd expect to be there. Again, these things can drift from day to day depending on market performance and changes in the float, but this fund's got Microsoft, Apple, Amazon. You see Facebook, Berkshire, Johnson & Johnson, then Alphabet twice. This shows up on a lot of funds where both classes of Alphabet or Google are held, and if you add those two together, you see that they become one of the top ones. So the top core holdings of this fund are Microsoft, Apple, Amazon, Google, then Facebook, Berkshire. This is basically an S&P 500 fund, but it has a lower fee than any other S&P 500 or total market ETF on the market. And I want to preface this, there are mutual funds with lower fees. There are zero-fee mutual funds. There are S&P 500 mutual funds with half the fee of this ETF, but there are no ETFs with lower fees yet, at least. I mean, fees change, and in fact, Vanguard just took their VTI, which is their total market, US market ETF, down from 0.04 to 0.03. And, it's possible it will eventually match BBUS. I think others will match them first. This is a very competitive business, and it's becoming all about the fees. It's becoming all about eliminating expensive indexes and finding cheaper variants in order to lower the fees. And this is the next example, going to a Morningstar index here. Cutting out the more expensive stocks to maintain in the index, the smaller, lower float, less liquidity, higher spreads between the bid and ask companies are all gone. And this should also reduce some turnover, not all of it, but it keeps it a more passive total index because it's just easier to contain at its size and also easier to understand. All right, let's compare some of these total market options to one another in terms of exactly what you get for your money. Here's the table I did make, so if there are mistakes in this one, yeah, blame this on me. But here are some passive index ETF options listing their current management fees and total number of holdings. So please note on top the first two, SPY and VOO, these are both S&P 500 ETFs. They list a little bit more than 500 holdings. Again, that's due to the difference in classes of shares, as well as the fact that these kind of funds often hold options or futures in order to deal with the way that these funds move around, just so that they can better track the index. Also, please note that the fees are dramatically different between these two funds. One has triple the fee of the other. There is literally no real reason to be holding SPY over VOO unless, of course, you are trading it and you find the bid-ask, the volumes, just more to your liking, and or you are selling covered calls, and it is true that SPY has a considerably richer options market, and it could be the case that your broker will not allow VOO as sufficient cover for options in SPY. In any case, looking at these ETF fees, you can see that most that are listed have a 0.03% fee. That has become sort of the industry standard. Several years ago, three companies, Schwab, State Street, and BlackRock, all seemed to agree upon that. Vanguard had 0.04. Last month, though, Vanguard met with both their S&P 500 and VTI. They met all their competitors at 0.03, of course. At roughly the same time, JPMorgan came in with this other product, BBUS, and it has 0.02, a new bottom. So the question is, will any of these other funds decide to match BBUS, and or will other new entrants consider coming in even lower? The answer is probably yes to both of those questions. If you ask me, what's the most probable first mover? Well, there's no doubt in my mind that SPY, that ETF, should lower its fee, and only isn't because it seems to not have to. It is a behemoth. It is the largest ETF. VTI is number 3 at the moment, behind SPY and then IWM, the Russell one. But you could see the fees are very different, and it's because the SPY is much more of a trading vehicle, while all the others beneath SPY, these are passive investment ETFs for individuals that for some reason are preferring ETFs to mutual funds, and there certainly are reasons why you might, and these are the lowest options. So if you ask me what of these others is most likely to lower its fee, I would say SCHX, which is Schwab's similarly cold, thinned out total market large cap fund has a slightly broader holdings matrix than BBUS, and perhaps that is the one to match in fees first or to reduce first. I don't really know, but at the moment, you can see the basic difference here. So with BBUS, you are getting more than SPY or more than the S&P 500, but you are not getting exactly the same as you would be getting out of the many broad total market indexes that do exist. Also, once BBUS gets a little bit more history, it'll be easier to tell exactly how this index differs from SPY and these other total market options, if at all. And if it does, whether that difference is a liability or an asset to this index. So this concludes my initial review of JP Morgan's Beta Builders US Equity ETF. I think it is a pretty good ETF. I like their very competitive, lowest in the industry ETF management fee, and it is a fairly sensible index that is market weighted with all your favorite players being at the top. Additionally, JP Morgan is a fairly large and well-respected bank that is unlikely to do much shenanigans in such a fund. More particularly, I believe that JP Morgan is going to push this fund hard upon private client customers, many of whom they will offer free, commission-free trading. So this is a vehicle into which many wealthy investors will be able to pile total market allocations without any transaction costs and into a very low fee ETF. As a result, I think that this fund will gain assets under management at a fairly brisk pace in the second half of 2019, and I do believe as a result it will become very competitive, and you will hear more about this fund or the larger funds that have already established assets under management will come to reduce their fees to match BBUS. All right, if you have any opinions on this fund or any of the others mentioned, or want to highlight an ETF that you think is even better or competitive, please let me know. Thank you. Appreciate your viewing.